Is the market efficient? In 1970, Eugene Fama from the Chicago Booth Business School created the market efficient hypothesis. The efficient market hypothesis states that share prices reflect all available information and consistent alpha generation is impossible. Alpha generation is excess returns relative to risk. So, is the market efficient? Richard Thaler, another University of Chicago economist, wrote a book called Misbehaving. In Misbehaving, Thaler essentially pointed out that there are times when the market clearly is not efficient. In chapter 25 of his book, Misbehaving, he wrote about closed-end mutual funds. What is a closed-end mutual fund? I think the best way to explain a closed-end mutual fund is to use an example. Now, please note that I am not recommending any of the funds that I'm reviewing here. I'm simply using a website that Nuveen has put together called cefconnect.com that everyone has access to explain a little bit more about how closed-end funds work. Adams Diversified Equity Fund, again, just as an example, not as something I'm recommending to buy, is a mutual fund that's been around since the 1920s. In the 1920s, mutual funds didn't exist. So Adams created a publicly traded corporation that owned other corporations. Currently, Adams has about 87 stocks, and they're large US companies. If Adams sold all of the Microsoft, all of the Apple, and all of the other positions in the portfolio, we can calculate the value of those positions on a daily basis, and they actually do. So yesterday at 4 p.m., January 24th at 4 p.m., the value of all of the holdings in Adams funds was $2.6 billion. That will change tomorrow and every day thereafter. But the number of shares in a closed-end mutual fund stays fixed. This creates opportunities. If you take the 2.6 billion divided by the 124 million, you get the value of every share. Every share is worth $21. Part of the efficient market hypothesis includes the law of one price. The law of one price says in the absence of friction between global markets, the price of any security will stay the same. Well, we just pointed out that the value of these holdings is $21.09. Therefore, if we were to buy this fund on the open market, we should also pay $21.09. But in the open market, other people are selling this for 18. Therefore, the fund is trading at a discount of 14% to the actual value. So there are two prices, not one price. The assets are worth 21, or the assets are worth 18. Perhaps all mutual funds trade at a relatively small discount because, as I mentioned, the law of one price says in the absence of friction between global markets. Is there a friction? Well, if that's the case, why would another fund trade for more than it's worth? The Gabelli Utility Trust has a value of $2.74 per share, meaning if all of the utility stocks in the portfolio were sold today, shareholders would each receive $2.74 back. But the share price is $5. So this fund is trading at an 89% premium to what its value is. So again, the law of one price is clearly wrong when you can buy these holdings for one price, or you can buy the fund and pay nearly double. We prefer not to pay double. Another Richard Thaler quote in his book was from Ben Graham. Graham points out that closed-end funds are initially brought to market at premium prices. In the early 1990s, I invested $1,500 in the Fidelity Hong Kong Fund. At the time, I didn't realize that only $14.12 would be invested in the fund. 82.5 cents was built in as a commission for the brokerage firms. Graham and the Intelligent Investor refer to these premium prices as, quote, an expensive monument erected to the inertia and stupidity of stockholders, end quote. I think Graham just called me an idiot. Well, the good news is I consider the education received from my mistake as the best $100 I ever lost. It's interesting to me that there are other closed-end mutual funds that are almost identical that trade at very different prices. BlackRock has two science and technology funds. The BlackRock Science and Technology Trust is worth 35. It's trading for 35, so it's pretty close to its actual value, about a 2% discount. But the BlackRock Science and Technology Term Fund, which came out more recently, is trading at a 21% discount. These portfolios are very similar. They're managed by the same fund family. Why would one trade close to value and one trade at a 21% discount? Furthermore, the word term has meaning. This mutual fund will actually terminate. When it does, the fund manager will sell all of the assets, currently worth $21.60, and give that money back to the shareholders. So if that term ended today, shareholders would make an automatic 21%. Why would anyone prefer to buy the fund that's trading at its actual value and does not have a term? The discount of this BlackRock and Science and Technology Trust could easily go to 20%. The same can be seen in a couple of Guggenheim funds. The Guggenheim Active Allocation Fund is a portfolio not of stocks, but of mostly bonds. It's 87% bonds. This fund is slightly different from Guggenheim's other fund, but they're very similar. The Active Allocation Fund is trading at a 12% discount. It also has a term date, so that discount will eventually go away. The sister fund or original fund, the Guggenheim Strategic Opportunities Fund, also has a portfolio of about 85% bonds, very much like GUG, same manager, but this fund trades at a premium to what it's worth. So its assets are only worth 12, but you pay 13. The last book I want to talk about, A Random Walk Down Wall Street, written by Burton Malkiel. Burton was very much in the camp of an efficient market. Otherwise, he wouldn't have talked about this random walk. The random walk, according to Investopedia, says changes in asset prices are random. Therefore, you can't buy a stock because it went up thinking it will go up more, or sell a stock because it's gone down and think it will go down more. It's random. And if it's purely random, there's no way to really invest other than long-term buy and hold. But Malkiel also wrote in his book, when discounts of 10% or more exist, it is time to open your wallet to closed-end funds. Back to Adams Diversified Equity Fund. The Adams Fund, as I mentioned, has been around since the 1920s. In the 30 years I've been managing portfolios of closed-end funds, this fund has always traded between about a 10 and 20% discount. The 14% discount is not likely to go away anytime soon. So those who are buying it shouldn't expect an extra 14% return in any short time frame. However, all closed-end mutual funds are required to pay out their capital gains and dividends every year. This drop here took place because Adams paid out a one-time lump sum distribution of its capital gains. It was $1.15 per share. If you look through history, Adams has done this on an annual basis, going back all the way to 94 and before. If, just to make the math easy, Adams' average distribution was 10% of the assets, it'd be $2.10. By investing in the same fund for only 18 and getting a $2 dividend, your return obviously is higher than 10%. In conclusion, I want to mention that we at Gerhart and Associates do think the market is inefficient. We do believe that over time, you can get superior results by buying discounted assets. And we utilize a closed-end fund approach to help our clients reach their objectives. So thank you for your time.